Hi, welcome to Real Talk on Real Estate with Mark Phillips, your local realtor. In today's episode, we're going to talk about you've decided to buy a home, now what's the next step? Got to find the money. I'm not the money guy, this guy is. Jeff Tisdale from VIP Mortgage. When we come back, he's going to explain to you everything you need to know to apply for a loan and get pre-approved. We'll be right back. Hi, welcome back to Real Talk on Real Estate with Mark Phillips and my friend Jeff Tisdale from VIP Mortgage. So you decided to buy a home, now you need to go find some money to pay for it. Jeff's going to talk to you about the actual approval process and what you need to do to apply for a loan and actually get him to say that you're worthy of that credit, and he's going to give you that loan. So Jeff, what's it take to get approved for a loan for a mortgage?
Well, it's not all that difficult. And what we need to do is set up an appointment, and we can do that face-to-face. We can do the application online, or we can do that over the phone. Some things that you should be ready to give the loan officer, hopefully me, would be, of course, your name. We need your birthday, social security number. I need to know your residence history for the last 2 years, where you've worked for the last 2 years, monthly gross income, name of your bank and how much money you have available for the purchase of the home. Ask you some simple questions about if you've ever had a bankruptcy, foreclosure, things of that sort. Then we'll pull a credit report, and depending on what your credit report comes in at, we'll know if we can go FHA, VA, conventional, and we'll just take it from there.
Jeff, there's some things that we always talk about when it comes to qualifying for a loan is debt to income ratio and loan to value ratio. A lot of people, including a lot of realtors, don't understand what that is. Could you explain to us what those are?
Sure, it's simple. So you have two different ratios. We say a front ratio and a back ratio. Most lenders now, investors, are just keying in on the back ratio. What the front ratio is your mortgage payment divided by your monthly gross income. And that gross income would be your salary, average bonus over the last 2 years, any commission average for the last 2 years, if there's child support, alimony, maintenance coming in, all of those incomes. It could be Social Security. All of that income would be your gross income before taxes. So mortgage payment divided by your total gross income. That's your front ratio.
Okay.
The back ratio, what most lenders key in on, would be your mortgage payment plus the minimum payment on any debts you have. Car payments, credit card payments, student loans, things of that sort. That number divided by your monthly gross income. That's your back end ratio.
For these types of, say, a standard conventional loan, what are the acceptable ratios for somebody applying for a loan?
That's a good question. Well, in March, there's going to be some mortgage insurance guidelines which are changing. Right now on conventional, you can push it up to 50% of your monthly gross income for your total debt, mortgage plus your debts. In March, if your credit score is under 700, you're going to only be able to go up to 45. On a FHA, for instance, you can exceed 50. We've seen them at 55, 57. But you need to keep in mind at a certain point, if the bank is going to give you more and more and push it 50, 60, 70, you have to keep in mind you still need to have money set aside for groceries and utilities. So usually what happens is clients limit themselves before the bank limits them.
Okay. Now, even though most people looking at applying for a mortgage for a new home, they can figure these ratios out themselves. You can kind of get a ballpark. This guy, the credit scores that you see are not necessarily what a mortgage lender will see. So if you go to creditkarma.com, the consumer credit score that you see there is not what Jeff is going to look at to evaluate your credit worthiness. So it's best, even if you're thinking about buying a new home, new or resale home, used home, 6 months to a year in advance, it's best to start now. Get with a lender like Jeff that you can file your paperwork, he can tell you what your baseline is. Because there's a little known fact that depending on your credit score, as your credit score goes up 50, 60 points or more, your interest rate goes down. So the lower your credit score, the higher your interest rates. That's going to cost you more money over the term of the loan. So if your credit score changed 50 points from 700 to 750, and we talked about this earlier, for a $300,000 loan, what was that, $25,000 to $30,000 over the cost of the loan.
That's
So you can save yourself some significant money by just improving your credit score now. So do your homework now, get with a lender like Jeff, improve everything you can, pay off credit cards, pay off debt, and get in the best position to get the lowest price or a bigger home, because you could qualify for more money or a larger payment if your credit score is better. Thanks for being with us today. Make sure you watch this Real Talk on Real Estate on Facebook, on my Facebook page. Like us and share us on Facebook. Check out Jeff's page, VIP Mortgage, his Facebook page, as well as his website. If you have any questions after the end of this little segment, I'll put up contact information for both Jeff and I, and you can get a hold of us if you need to. Thank you very much. This is Mark Phillips with Real Talk on Real Estate. Thank you very much for watching.